This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're still looking at foreign exchange risk management, and in the previous lectures we looked at using forward rates and money market hedging. We're now looking at using what we call currency futures, which are rather different, and well, I'll obviously explain as best I can. Strictly, what futures are a little bit like forward contracts. Futures are the right to convert at a fixed rate on a future date. On a future date. However, what makes them a lot different is that instead of giving you the right to convert at any future date, if they're traded, it's 1 month, 2 months, 3 months, and so on. But instead of any future date, futures only give you the right to convert at one of 4 fixed dates. We have what we call March futures. It's the quarter days, so March, June, December, September and December. What they mean, a March future is the right to convert on the last day of March. Similarly, a June future, the right to convert on the last day of June, September, December. So there are always, in practice, 4 futures prices quoted, but they give you the right to convert on the very last day of March, June, September or December, which does make them rather restrictive. I mean, fine, if you knew you were going to need to convert on the last day of March, fine, a March future would effectively be very much like a forward contract. But because they're so restrictive, very few people actually use them to actually convert money. These futures are traded, and they'll quote rates. You know, a March future, if it's dollars, pounds, maybe quoted at $1.50 or something. Well, that would give you the right to convert at the end of March at $1.50. But they are traded. And so just like from day to day, exchange rates go up and down. Similarly, futures prices go up and down. So the futures price today for a March future may be $1.50. Come back next week, it might be $1.52, it might be $1.48. Just like spot rates go up and down, so do these futures prices. And what a lot of people do, as I say, because they're traded, you can buy futures, you can sell them. A lot of people use them for gambling. You see, if a March future today is quoted at $1.50, you can buy or you can sell in the hope that the price will go up. Obviously, people do gamble on exchange rates. They could gamble on spot rates. If today's spot rate was $1.50 and I thought it was going to go up to $1.52, then you can gamble. You know, you can buy dollars at one price, sell them at another price and make a profit. But exchange rates tend not to change by very much. And so to make a decent profit, you'd have to buy an enormous amount of the foreign currency. There's not much point in buying $1,000 if all you're going to make is $1 or $2 profit. I'd rather buy $1 million and make a huge profit. Well, the beauty of futures, certainly for a gambler or a speculator, is that if today's futures price happens to be $1.50, the right to convert money at $1.50 at the end of March, if you thought that price was going to go up, buy futures today at 150 and sell them next week at 152. Fine. But unlike speculating on the currency itself, with futures, you don't settle up until the end. What I mean is, if the price today was 150 and I thought it was going to go up by next week to 152, then all I do, I ring the dealer today and say, oh, buy me 1 million futures at 150. I don't actually pay any money. And then in a week later, I ring the dealer and say, sell me 1 million futures. And if the price has gone up, at the end of the deal, we settle up. The dealer will say, well, you bought at 150, you're selling at 152, you've made a profit of 2 cents on each future. And he'll pay me the profit. Equally, of course, the price might go down. If the price turns out to have gone down, if I bought at 150 and I come to sell a week later at 148, again, it's ring the dealer and say, buy me 1 million. A week later, ring the dealer and say, sell me 1 million. It's only at the end we settle up. And so, here, if the price has gone down, I would have to pay the dealer the difference. So that's the real beauty for a speculator, a gambler. If you gamble on the currency itself, you actually have to physically buy dollars. Sell dollars. Well, I can't afford to buy $1 million. But with futures, as I say, you don't pay for anything. You settle up at the end. Ring the dealer and say buy. Ring a week later and say sell. The dealer calculates the profit or loss you've made. And if you've made a profit, they pay you. If you've made a loss, you pay them. So you can obviously gamble a lot more. I can't afford to buy $1 million, but I can certainly afford to make a phone call, and it's only at the end we'll settle up. Having said that, something I will mention again later, the dealer's not stupid. The dealer will want a big deposit, and it will be big. It could be 30% of the money. That's up to the dealer and your credit rating, but you will be expected to pay a big deposit at the beginning. You get the deposit back at the end, together with any profit or pay-in, or less rather, any loss. However, as I've said, people speculate on futures. Oh, and incidentally, one more thing that's rather nice is that if you're speculating or gambling on futures, I hope I've made it clear, you could buy today. Maybe the price today is $1.50, but again, it's simply a phone call. And all right, later you come to sell them, and maybe you sell next week. And maybe I thought the price was going to go up. Well, if it has gone up to 160, the dealer pays me the profit of 10 cents. But what happens if I thought the price was going to fall? No problem. Because since it's just 2 phone calls, what you can do is ring the dealer today and say, sell me 1 million futures at a price of 150. I haven't got anything to sell. Doesn't matter. It's simply a phone call. But later, we have to finish the contract. And so next week, I ring the dealer and say, buy 1 million futures. And if I was right and the price has fallen, well, it's only at the end of the deal that the dealer calculates the gain or loss. Here, if I'm selling at 150, I'm buying at 140. Again, we've made a profit of 10 cents. The dealer pays me the profit. Of course, I could have been wrong. It could be that by next week, the price has gone the other way. It's gone up. Fine, we sold at 150. If I end up having to buy at a higher price, then I've made a loss. I would have to pay the dealer. So I hope we're clear so far. I'm about to put some numbers to it. But with futures, there's a price quoted every day, just like there is for the spot rate. But with futures, you can either buy futures now and sell later, or you can sell futures now and buy later. And it's only at the end of the deal that the dealer looks at the difference between the buy price, the sell price. If you've made a profit, dealer pays you. If you've made a loss, you pay the dealer. One last thing before I do put some numbers to it and hopefully make sense of it all. Just suppose I buy March futures today, and the price today is $1.50. And I buy because I think the price is going to go up and I'll make a profit. Suppose it turns out next week the price has gone down, I'm making a loss. Well, I'm not going to sell, I don't want to lose money. I still hope, all right, maybe the week after the price will go up. But suppose the price keeps going down. Well, if the price goes down, I'm losing money. Obviously, I don't want to sell. I'd rather wait and wait and wait until one day, hopefully, the price goes up. However, there is a time limit. Although you can finish the deal anytime you like, I bought them, I can sell them tomorrow, I can wait till next week, I can wait till the week after. We must finish the deal. We call it close the deal, which here would mean sell. We bought today, we have to sell sometime. We must sell by the last date of the future. And I said earlier, if we're dealing in March futures, they finish at the end of March. We must sell by the last day of March. If we were dealing in June futures, we would have to finish by the end of June, September by the end of September, December by the end of December. So in practice, there are always 4 futures quoted. March, June, September, December. And whichever one you've chosen, you have to finish the deal by the end of the relevant month. So hold on as long as you like, but when it gets to the end of March here, we would have to stop, whether there was a profit or a loss. All right, well, I said people gamble on futures. However, the job of the financial manager is not to gamble. The job of the financial manager is to hedge against risk. And let me show you with a very basic example, first of all, example 8, how the financial manager can use futures. Now, this is a very simple one, but to illustrate the way we use them, when we've sorted that out, then I'll show you what you might call the restrictions, why it's not quite as easy as it looks. R is in the US. Now, importantly here, we're in America, so we deal in dollars. We need 800,000 on the 10th of August. The spot today, well, today is the 12th of June, and the spot rate 1.5526 to 1.5631, which is of no direct relevance, of course, because we're not going to convert today. We don't need the money till the 8th of August, 10th of August. But just so I can illustrate, just suppose we converted today. What would happen? Well, we need £800,000. The quota, remember, it's £, 1.5526 to 1.5631. And so £1 is 1.5 something dollars. Here, remember we're in America, so we'd need to buy pounds, which would mean selling dollars. And so we'd use the higher rate, 1.5631. And if we were converting today, it would cost us £125.0480. Remember, we'd be paying it. That's what it would cost. Now, fine. The problem is we're not converting today. We're waiting until the 10th of August. It's the 10th of August we're going to convert. And obviously by the 10th of August, anything could have happened to the exchange rate. It might go up, we end up paying more. It might go down, we end up paying less. However, there are futures available. And so what we do is this. We leave the transaction at risk. And so the 800,000, as you'll see shortly, we leave it at risk and we will convert on the 10th of August. And as a result, since spot rate will have changed, it may cost us more, it may cost us less. However, to what you might call cancel that risk, we will today buy these September futures. It's 800,000 we need, so we'll buy 800,000 September futures. Oh, I keep writing the wrong side. It's £800,000 at risk. At today's price is 1.5580. Now, futures prices are different from spot prices. Remember, the futures price is the right to convert on a future date. But spot and futures prices do go up and down together. And so what's going to happen? If the spot rate goes up, then on the 10th of August, we'll end up having to pay out more money. But if the spot rate goes up, the futures price will go up as well. And so if I've bought at 1.558 and it goes up, fine, on the futures I'll make a profit. And as you'll see, the idea is to have two risks that cancel each other out. If spot goes up, we end up paying more money. We're losing on the transaction. But if spot goes up, futures will go up. We'll make a profit on the futures. And the idea is for the two to cancel out. A loss on one is cancelled by a profit on the other. It could work the other way. If the spot goes down, we end up paying less. We gain on the transaction. But if spot goes down, the futures will go down. Bought at one price, sold at a lower price, will make a loss on the futures. Again, they'll cancel out. From day to day, spot and futures go up and down. On the transaction, profit or loss. On the futures, the opposite, profit or loss. One risk cancels another. Let me show you what will happen on the 10th of August. So remember, all we've done today, transaction, we just left it, the 12th of June. The 12th of June, I've rung the dealer and said, buy me £800,000 worth of futures. Apart from paying a deposit, which we don't worry about in the exam particularly, it's not actually cost anything. We wait until the date of the transaction, and on the 10th of August, we look to see what's the spot rate and what's the futures price. Well, it says here, show the outcome of a futures hedge, assuming that the spot and the futures prices have both gone up by 0.02. So what will the spot be? If it's gone up by 0.02, the spot rate will have moved to 1.5726. I've added 0.02 to 1.5831. As I said, although they're two different things, as spot rate goes up and down, the futures price also goes up and down. So the price of September futures today is 1.5580. If it goes up by 0.02, it'll be 1.5780. And now let's look what will happen. First of all, the transaction itself. Remember, we're in the US, we want to buy £800,000 and we left it at risk. So we convert at whatever spot happens to be. So 800,000. Again, we're having to buy pounds, and so the higher rate, 1.5831. And so we end up having to pay $1,266,480. So we've lost on the transaction. As of today, it would only have cost $1.25 million. The spot rate moved against us. We've had to pay $1.266 million. However, on the same day, we finish the futures deal. We close the futures. And what was our futures deal? I'd rung the dealer and said, buy me £800,000 worth of futures. And when I started the deal, the futures price was 1.5580. So I bought at 1.558. I finished the deal on the 10th of August, and we have to sell them. Well, the price on the 10th of August is 1.5780. And so the dealer simply takes the difference between the buy and the sell price. If there's a profit, they pay us. If there's a loss, we pay them. And what were the prices? It's the sell minus the buy. We bought on the 12th of June at 1.5580. When we come to sell on the whatever date it was, 10th of August, so sorry, that's the 12th of June. On the 10th of August, when we come to sell, the price is 1.5780. And remember, these prices were dollars per pound. So on every pound, the price has gone up by 2 cents. And so how much profit have I made? 800,000 times the difference of 2 cents. It's 2 cents for every pound. So a profit of $16,000. It's a profit, so the dealer pays me. It's a receipt. And what's the net result? I pay out to do the converting 1,266,480. I receive 16,000, the profit on the futures. the net result 1250480. A net payment. Although for reasons I'm going to explain, this is a bit too perfect. Things are never this perfect in real life. But here is to show you the idea that we've ended up paying 1.250. Just here it's exactly the same as if we paid now. We've effectively fixed the amount. However, whatever happens to spot and futures prices, as spot goes up, we pay more. Try it yourself. If it went up by 0.03, we'd pay more still. Whichever way you like. We're losing money, we pay more. But equally, as spot goes up, futures go up. And the more they go up, the more profit I make. The loss on the transaction is compensated by the gain on the futures. And it works both ways though. The spot could have gone the other way. Suppose the spot rate had gone down at 2 cents. If it had gone down 2 cents, I'm not going to redo the whole question. You should be able to visit it or try it yourself. But if it had gone down 2 cents, it would have gone down. It's 5631. It would have gone down to 1.5431. And so we gain on the futures. We gain on the transaction. I beg your pardon. We'd be paying less. However, if spot went down, futures price would have gone down as well. And instead of it going up by 2 to 1.57, it would have gone down to 1.5380. We sell at 1.538. We'd bought at 1.5580. We'd have made a loss on the futures and we'd have paid into the dealer. But try it yourself if it's not obvious. You'd have lost on the futures, you'd have gained on the transaction by paying less. The net result, though, would be that you'd fixed the net amount at 1.25, whatever happened. So I hope you're clear how they're working. Leave the transaction at risk. To cancel that risk, deal in an equivalent amount of futures. So 2 things at risk, but you've done it such that as one goes up, the other one gains, the other loses. Or as one loses, the other gains. One risk cancels the other. The only problem is, in real life, that this is a bit too perfect. For 2 main reasons. One is, with futures, you can't just deal in any amount. Here we were at risk on £800,000, so we gambled 800,000 on the futures. In fact, there are what they call contract sizes. And if I told you that the contract size was £150,000, you would have had to deal in blocks of 150,000. So you couldn't have dealt in exactly 800,000. I'll illustrate that with the next example. The second problem is, although in practice with very efficient markets, so futures prices, as spot goes up, futures goes up, as spot goes down, futures go down. However, they are 2 different things, and they don't, in fact, move exactly together. In this example, I could fix the amount exactly whatever happened because they'd both moved by 0.02. Spot had gone up by 0.02, futures had gone up by 0.02 as well. Well, again, in practice, spot might go up by 0.02, futures might go up by a slightly different amount. And I'm sure you can imagine, even before we look at the next example, that if they don't change by exactly the same amount, it won't exactly net off the way I've shown it. So those are the two problems we have to deal with, coupled with the fact, you'll see again, here we were in the US. If we'd have been in the UK, well, it gives us a few extra conversion problems. But anyway, I illustrate all of that in the next example, which is more what you might call exam standard. However, we'll have a break here so you can think about it. In the next lecture, I'll go through example 9, bringing in those two problems.